It's almost end of the year and there are so many tax tips out there. Today I want to share with you a tip from Jamie Golombek, CIBC, which I will link down below for the source and you can read all the tax tips that he presents. I am going to share about tax loss selling because it relates to me as a DIY investor who holds US and Canadian stocks. So in principle, the tax loss selling is just a way of realizing your capital loss when you have capital gains. So let's say you have shares that have gone up in value, you made money, you sold it, and then now you also have some shares that have lost value and you want to sell it to get the capital loss. Well, the capital loss will offset the capital gains. Now, the concept is simple unless there is an exchange rate involved. So let's say you bought 1,000 shares at 10 US dollars. You would have paid $10,000 US. If at that time Canadian dollar is at par with US dollars, you would have paid 10,000 Canadian dollars for that 10,000 US dollars. Let's say today or on the day that you want to sell, the share price has dropped to $9 from the original $10. You would have lost $1, and on 1,000 shares, it's 1,000 US dollars. So you decided to sell the 1,000 shares, you get 9,000 US dollars. Now, if the Canadian dollar on that day is weak, so let's say 1 US dollars is 1.35 Canadian dollars, your 9,000 US dollars would yield 12,150, which means it's higher than the $10,000 that you originally paid for those 1,000 shares. So in reality, you actually have capital gains, not capital loss. So the lesson is be careful when you want to implement tax loss selling and make sure you take into account the exchange rate also. I will link the Jamie Golombek's tax year-end tax tips down below. Have fun!